more people come in, that'd be great. I was expecting 5 to 10 people, so we almost there. We're gonna be on live stream. And what's up YouTube? If y'all can hear me, thank you. We're gonna get into our group investing seminar here shortly. We are in person, the first time in I want to say 2.5 years maybe, since we did this. So it's exciting to be back in person. So let's just go around real quick since it's just us and say, kind of what we do and what we're hoping to learn from tonight. And then you guys talk. Chanel, we'll start with you, and Michelle, and then we go around, and then I get to it, and then we gonna get into the presentation because we got some folk that's gonna be online, want to tap in. So Chanel, tell us about yourself and why you came out tonight.
My name is Chanel McClure. I am a hairstylist. I have a hair salon in Lafayette, and
Nice.
I actually just got a job.
All right.
At PG&E, so I wanted to use that as my leverage to buy real estate and invest because self-employed doesn't look good when it's time to buy real estate.
For finance, good point. PG&E, if you got to work somewhere at PG&E, that ain't a bad spot.
Right.
So,
I like that pension
right. So thank you for coming out. And I know we've connected online a couple of times, talked a few times, and you were telling me about your business. It shows. So thank you for coming out, Michelle.
Thank you. Yes, I'm Michelle Mead. I'm a real estate agent. I'm actually also a former hairdresser for over 25 years. What? Yes, ma'am. So I recognize exactly what you're talking about, and recently was able to pick up some parcels of land that I'm using as investment property to bring in payments over time so that I can finally, almost like a retirement. But so I'm excited to hear how we can get more money together and make bigger investments.
Right.
Excellent. And doing a great job. You actually became the bank by buying some land, tax deed auction, right?
Yeah.
Then selling it with seller financing. Yeah. Selling it with seller financing, you get a little bit of money down, carry the loan like you would, like a bank would.
Yeah. Right.
And so you got consistent income coming in. That was a great method of what she does, and she's our top producing agent here at the office. So with that kind of experience, you're able to help investors out in the marketplace go out and bob and weave through these interesting times that we're in. So thank you for coming. And but over here, tell us about yourself.
My name is Claiborne, and my background is photography and videography or whatever,
really?
Sound. And I was looking forward to learning more about real estate and investing in property, and just how to be savvy in it and own my own home.
Absolutely.
For the future.
Absolutely. Well, I think this is going to be very applicable to what you try to do as well, because we're talking about group investing, syndications, putting together investors to go out there and buy property. And that could apply whether you're buying a hotel, an office building, a single family house, a duplex, a fourplex. It's the same principle. It's just putting dollars together from putting resources, not even just dollars, together from a couple of different parties, and then going forth and making a deal happen. That is really the basis of what entrepreneurship is all about. You think about what a business is. An entrepreneur has an idea. They got to go and get some financing for it. They raise money through a loan, or they raise money from investors, and they go hire a team, right? And they put the team together, and they have an idea, venture capital, and they go out and try to make some money. Right? And so essentially what we're talking about when we say group investing in real estate is being entrepreneurs, right? Particularly, and I'm gonna get into the structures here, where you put together LLCs and different entities. You are a business owner, you are an entrepreneur. And whether you're full-time in it or you have a full-time job, many real estate investors are full-time employees. In fact, one of our agents here in the office is a full-time employee for Apple. He's been with Apple for years. And he does well as a real estate agent, and does very well as a real estate investor. I mean, he's vested in Apple, right? So he's got some nice, I would imagine, stock options from back in the day, right? And a great job at Apple. So that's what, Apple's a great company to work for. But he's investing in real estate consistently, has been doing so, I believe, the last 10 years, and built over a couple $1 million in equity for himself and his family. So that's what we're talking about tonight. And we're going to get into some high-level stuff, but I promise y'all, I'm going to make this understandable as if you just got into real estate, right?
Oh, yeah.
And this is, again, it's on YouTube, so if you want to share this with somebody, it's live now, but it will be recorded, so if you want to share, however you want to do it, please get the info out. So, my name is Steve Peterson, and I'm the broker and owner of Infinity Investments. Infinity is a brokerage company I started in November 2009, in the midst of the storm, right? And so now we're in a rising interest rate environment, right? And it's totally different from what it was in 2008 and 2009, but it's a change because in the last, really since that time, and before that time, really, when the Great Recession happened, interest rates before that time were very, very low. And then the Great Recession happened, mortgage rates started to adjust, and the rates were still low. They still were sub 4%, around 4%, 4.5%. They certainly wasn't at 5% on average. And where we are at for homeowners is we're high 4%, we're looking at a possible 5% interest rate this year for homeowners. And typically, commercial investment property interest rates are always a little bit higher than homeowners. Right now is a weird time. I've seen several commercial loan rates lower than residential rates for homes in the last couple of weeks. I'm pretty sure that's going to reset. I'm pretty sure a lot of commercial loan rates are going to go up, probably, and they should be traditionally are above where residential rates are. So we're in a little bit of a shift, but I want to encourage y'all that that is a good thing for business in general, for people who have a creative mindset and learn how to structure deals. Because that is when some of the best deals, when there's a shift in the marketplace and there's a changing of the guard, so to speak, and that is your best opportunity to step into a great deal. Because when Alibaba and the 40 Thieves is out here bidding on every property that comes on the market, right? If you've seen the property get listed on the market, it's got 1 million offers. You know, last year was it commercial, residential, it didn't matter what it was. There was 1 million offers on a property. So to get a great deal was very difficult, right? It's when the time shift that the opportunity represents itself. So when November 09 is when I started the company. Now, it was blood on the streets.
It sure was.
It really was. I'll tell you an example of when I say blood on the streets. I did a deal. It was an 81 unit apartment building. I brokered. I sold. And we closed escrow in May of 09. It was an REO. It was a foreclosure by the bank. And when I say it was blood on the streets, that property, I pitched it to a bunch of people. Nobody wanted it. I pitched it to the guy who ended up buying it, who's one of my best clients to this day. And he had some foresight because he had sold most of his buildings in 07. Paid the taxes. He didn't do no 1031 exchange. He was smart. He said, hey, man, so I'm looking at this marketplace. I'm not able to buy nothing that makes any sense. So I'm just going to sell and wait. And he did that. I told him he needed to write a book because he timed it perfectly. So he had $9 million on the sidelines when the Great Recession came. So when he saw this deal, he seen opportunity, right? Because he was prepared for it. And when we did this deal in the middle of escrow, now I'm driving to the property on a Saturday. This is in Deep East Oakland, 66 MacArthur. I'm driving to the property, right? I got these things they call tenant estoppels. I'm going to deliver the estoppels to the property manager. I'm all excited, man. This is going to be the biggest commission of my life. I'm juiced. I'm in here, you know, dancing on my way. I get down 73rd, it's blocked off. I'm like, man, I got to drive around. I get the other, it's blocked off. Man, it took me, what was a 5-minute drive to get to the property from my house ended up being a 25-minute mission. When I got there, I said, what's going on, man? It's police helicopters. I talked to the manager. He said, oh, man, it's horrible. 4 police officers just got killed down the street. It was 4 police officers that just got killed. It was it made CNN news.
Was
right?
it the one with the guy who got out of jail and the lady harbored her brother?
Mixon was the guy, the shooter. He killed 4 police. He was wanted for something. They pulled him over. Instead, he didn't even talk. He just gunned those 2 police down, ran into a building. Police followed him in there. They gunned 2 more police down. That happened in the middle of my escrow. You know what I mean? I'm driving to the property. I'm thinking, oh, man, he ain't going to buy this property. I'm thinking, man, I mean, who would want, this is literally the 74th was on 68th. between 66 and 68. So I'm thinking, this deal is dead. Man, what am I gonna do? Because at those times, we was eating beans and rice and top ramen in the real estate industry at that point. Unless you was already set up and established. If you was a young pup in the game, I went back to the beans and rice and top ramen. Luckily, I had some experience with that, so it didn't throw me off, right? But my client persisted and closed that deal. A year later, he refinanced it for over $4 million. He bought that property for $3.7 million, 81 units. Previously, it sold for like 8-something million, right? I knew it was a deal because we run numbers, and we were able to run numbers on
It
properties.
was previously sold for what?
Like 8-something million,
What?
and he bought it for 3.7. This was 09, right? But at that time, what happened is we didn't know where the bottom was. And I'm giving you this long story because there was so much uncertainty. And that's the word that I see out there in the marketplace more than ever right now, uncertainty, right? But I've been there before, and I've watched and I've helped people make millions of dollars. I made a couple of dollars too, but I saw that era of time, right? And lived through that. And so when I went through that, I was at a brokerage at that point. I started my own company. I was saying, if I can live through this and I can live through that particular escrow, then I think I can start a company. And so my words to you guys out there who might be looking and seeing some level of uncertainty in the marketplace, some level of frustration with what's going on. Maybe your frustration is, shoot, every time you find a good property, you get outbidded for it, right? That's a good we all had that in the last few years. But a change in the market, a change in interest rates, can be the very opportunity you've been waiting for. And that's when I started my company, and I've got countless examples of people who started at that time or who invested at that time that really made a fortune. And for me, that was me getting going with my firm and me being an independent business owner. So it was a great time. Now, a little bit about myself in terms of who I am since then. I've had the honor of being the president of a couple of great organizations. First of all, the Associated Real Property Brokers, which is the Oakland chapter of NAREB. NAREB is the National Association of Real Estate Brokers, which is the Black Brokerage Association. We're called realtists as opposed to realtors because prior in 1947, when NAREB was found, blacks was not able to be realtors. We were not allowed to join the Realtors Association. So therefore, we formed our own organization, NAREB, as a method and means in which to conduct real estate business. And our motto is democracy in housing. And NAREB has championed all the fair housing laws, from that time to now. And that's still to this day what we stand for. So I had that great honor of being the Oakland chapter president at ARPB, 2015 and 16. I also was the state chapter president, which is called KRAB, California Association of Real Estate Brokers, 2017 and 18. Now, I also hold a designation. It's called CCIM. CCIM stands for Certified Commercial Investment Member. It's a commercial real estate designation that you get, but also, and more importantly, it's a network. They've got chapters across the country, and I've done tens of millions of deals through the chapter and involvement. I was also the president of NorCal CCIM in 2018, first African-American president of NorCal CCIM. So in 2018, I was busy because I was president of KRAB and CCIM. And I say all that to you is that in going through those processes, what I learned was how to organize, develop, and lead a team. And that directly correlates to what you will be doing in group investing, what I do when we put together groups to invest. Because you are dealing with people and investors, they are not your employees. They do not work for you. You know what I mean? They work with you and they put capital up. So you have to honor them just like a board member. When you're working on a board, like if you're a president of any organization or your company, right? And you got a board, you can't just go in there and tell the board, well, look, this is what it is. This is how it's going to be. Now, even CCIM and Realtors, one thing that's consistent I remember is having a bunch of board meetings where I might have had some great ideas and my board didn't necessarily feel that way. And in order to get your agenda or your point across, you have to operate through collaboration. And that's a key thing that I want to stress to you guys as we get into our topic of group investing is collaboration. And that's where if you are a part of an organization in your industry or you're looking to gain those type of skills, look to volunteer in boards because I got a crash course on actually how a board works, but more importantly, of how to be a leader in that board, and that translates directly to real estate and what we're talking about. Now, our company, Infinity Investments, we specialize in commercial and investment real estate, but we also do syndications, which is what the topic of what we're going to talk about tonight, bringing groups together to buy properties. And mid-size apartment buildings is our specialty from a brokerage, sales, and acquisition standpoint. That's what we do. And we've been doing that for a minute. Now, in today's agenda, we're going to go down, you will understand what group investing is, the different forms of group investing, the pros and cons of investing in real estate as a group. And remember, you can do a group investment in anything you can think about. If you have a business you want to start, you want to go buy some stocks, you know what I mean? You can form a group. And that's what's smart. That's it. When you're out there trying to buy a house, for instance, 30% of the residential homes, single-family homes in the last couple of years have been purchased by what's called hedge funds, private equity funds. Those are groups. And that's at a corporate level. A lot of those investors are also small groups where it's 3 or 4 or 5 investors. But now because they put their money together, they're able to come in all cash, whereas you individually might be coming in, you got a loan, and you're trying to make it, but you're competing against either BlackRock, the biggest hedge fund in the world, or ABC investors who got $2 million in the bank, and hey, they've got 4 investors, and they got a business enterprise, and they're going out there making it happen. So that's part of why it's been so competitive in the single-family home space. But that's also what you can do in the investment world, all right? And very important. But I'm going to talk about the pros and cons of that as it relates to real estate, particularly the avenues of raising money and the first action steps you can utilize to get going. And because we got an intimate group, if you have some questions, go ahead and lob it out there. If you're online, if you got a couple questions, maybe throw it out there, but I could get to you guys at the end of the presentation. So, what exactly is group investing? Essentially, it's when 2 or more people, investors, get together and acquire a property. They effectively are a group that owns the property, but the structure can be very, very different and take many different forms, all right? But just understand, you, your cousin, get together and you buy a property, your group. Now, how is that group going to be structured? There's a bunch of different legal entity options of how you can structure your group or how you can invest in a group, all right? One that's very popular right now is the DST. It's called Delaware Statutory Trust. It is an entity, much like an LLC, that allows flow through of the income and expenses and allows people to invest into that property as a group. And what's important about DSTs is that structure allows for people who are doing 1031 exchanges, and they're selling their investment property and then going to be then taking those proceeds and then reinvesting them, right? That they can invest in the Delaware Statutory Trust, right? In that structure. They can't just invest into a group where it's only an LLC, because that investor has to have what's called a deeded interest into the property, right? Deeded interest. So a DST will allow for that. Also, a TIC, tenants in common. A tenant in common will also allow for investors to 1031 exchange out of a property that they sold and into a group, because they would get a deeded interest into the property, right? That's very, very important. I started with those 2 structures because I've been on 1031 exchanges heavy. And if you follow me online, you done seen one of my videos about 1031 exchanges, right? And I put a big emphasis on those. Obviously, as a company, we do it all the time. But in this competitive environment over the last couple of years, I've been seeing a lot of stress and anxiety around this with our client base, stress and anxiety in the broker world, because it is difficult to find properties. When you exchange, you have a limited time to go out and buy properties. So DSTs and tenant in common structures can be a great avenue for people who are exchanging and trying to find property. Big companies that are big syndicators that are going out and buying properties in big funds, typically when they're raising real estate capital, they're going to bring in investors via a DST or TIC. In the old market before the Great Recession, most investors most of these big funds or companies will use a tenant in common structure. Nowadays, they use the DST structure. Now, I'm not a lawyer, and I don't even want to even think about getting into that, but the bottom line is the DST structure is a little bit easier for people to deal with than TICs. How and why and all that, I don't know. I know a lot of when things went bad, for instance, when the tenant in commons structure was there, it caused a lot of problems. So lawyers a lot of times are saying, you big sponsors, you should be doing Delaware Statutory Trust. Now that is kind of, you can do it as well, but it is really designed for the bigger sponsors, somebody raising money, maybe it's 40, 50 investors, okay? But it can be done, you can do that as well. What's more typical for the small investor is general and limited partnerships. Now, general partnerships are not a good way to really hold a property or really a business, because all the liabilities are on all the partners involved. All right, and as an investor, somebody coming into investing with the group, the whole purpose of why they're investing into a group is that they are trying to limit their liability to just the money they invest. All right, so a general partnership don't allow you to do that. A limited partnership, however, does. Limited partnership, there is a general partner, there is someone who's managing the partnership, but then the investors are limited partners. So that means their risk is simply just the money that they invest. Now, a lot of people think, oh, well, you know, what do you mean their risk is only the money they invest? Because in real estate, let me ask y'all, we got a small group. What are some other risks that you have in real estate outside of losing your money? Yes, you can lose your money, but what else? What are some other risks that you might encounter?
The soil on the property?
Soil, environmental risk. Yeah.
Or if the property is in an area of like flood or water.
Flood, water, environmental, what else? The structure, earthquake, or the termites might have ate through the through the beams, you know. What if somebody slipped and fall, bust their head?
Yeah.
Talking about my back and my neck. All right, that could be a liability. So, and then, but the biggest risk in real estate is mortgage risk. That mortgage company, you don't pay that mortgage, they will come and take your property, and your credit's gonna have a big black eye on it. That's typically a bigger risk because insurance can take care of slip and falls, typically floods, and one thing is earthquake. We live in an earthquake zone, so a lot of people don't got earthquake insurance. All right, it's something to think about because it's not financially feasible. However, something to think about, and that's why in the Bay Area we have all these earthquake retrofit laws. But there is risk in real estate, and investors love to minimize that risk by being a limited partner. Or like the next structure, LLC, limited liability company. This is the LLCs have become the more popular way to hold real estate and to hold businesses, right? And since when I got involved in real estate was 03, limited partnerships were real popular, but LLCs was taking over. And LLCs have kind of really replaced limited partnerships, and LLCs are very, very similar. But most people, most lawyers, most accountants tend to like LLCs. It seems to be an easier way to hold property. It seems to be an easier way to flow through the income, the expenses, and everything that has to do with that property. So most of our deals are going to be done via LLCs. Most of your deals are going to be done in LLCs. Now, well, here's another thing to think about, like with TICs, you can combine a tenant in common structure with an LLC. And the lawyers can get involved and figure all of that out. But you can do that. Now, REITs, real estate investment trust. Every time I talk to somebody about group investing, they're like, oh, you're doing a REIT? I'm like, well, not necessarily. Or a REIT, a real estate investment trust, is for a huge, I think the minimum is like 100 investors. And I could be wrong on that, but it's no sense in doing a REIT if you're not going to do it big. Because REITs have certain rules. They got to, income companies, they got to pay out. I don't want to say dividends, but yield. Public companies, they got to pay out dividends, but they got to pay out yield to their investors. There's all kind of rules. There's all kind of regulations. There's all kind of costs. There's all kind of things that you got to deal with when you're doing a REIT. And you would only do a REIT when you're doing it big, right? You're not gonna do a fourplex with a REIT. You're doing a REIT on a 100,000 square foot shopping center or a 200 unit apartment, and you're making the business, you're in the business of doing that, right? I will say this, a lot of the stock market companies that own real estate, there are REITs. And I own real estate as a business is what I mean. A lot of companies own real estate, but own real estate that's their business model, is owning real estate, right? Therefore, if you're doing a large deal, that might be something you want to look at. If you're not, one of these other structures would make sense. And the last couple are community land trusts. Now, community land trust is a public-private partnership and or a public way, a public, usually a city, a county, a jurisdiction, will partner typically with a nonprofit for the purpose of owning properties and preserving them for whatever reason. It could be preserving them for affordable housing. It could be preserving them to keep businesses in the area. It could be a variety of reasons. But this is a great way now. It involves the public. So you got to deal with, maybe City of Oakland. If you ever did anything with the City of Oakland, we love y'all, City of Oakland officials. But doing anything with the City of Oakland or San Francisco or Berkeley can be tedious because they got a million layers of red tape. But it could be a great way of preserving properties for particular things and preserving culture. And a lot of these community land trusts are circulated around cultural properties or historic type properties. But that's just another way that we can own properties as a group. And one that's more popular and recent, and one that I'll mention, but it's going to be the topic of next month's seminar, is opportunity zone funds. And that relates directly to opportunity zones. What an opportunity zone is a federally designated area, typically in a lower to moderate income census tract, where investors can defer capital gains, meaning they can invest into these funds, and if they had money that they made, or they had capital gains, say they sold a property, and they made money, they had a capital gain. Say they sold a stock, they had capital gains. Say they sold a business, they had capital gains. Fine art, gold, silver, precious metals, whatever. They got a gain. They made some money, got a gain. And the Golden State, you're going to get paid. Uncle Sam is 21% minimum, and Uncle Gavin and them is at least 9.5 minimum. So if you made $1 million, you're paying $300,000 off top. That's the minimum, right? Depending on your tax bracket. So there is a real demand for people who want to defer those capital gains. And if you invest into an opportunity zone fund that invests into a project located within an opportunity zone, you can defer those capital gains. Many of those opportunity zones, the areas, are in urban core, what's called urban core real estate. Real estate that is structured in the urban core, in typically central business district areas or along transportation corridors. And these are great areas for investment. And in fact, these are going to a lot of times, these are going to be black and other minority neighborhoods, all right? So this is a great opportunity for people from wherever you are to reinvest into your own neighborhood and to be able to attract capital from maybe institutional places that typically would not have invested in those areas before. And as somebody who's been doing this for a while, I cannot tell you how many, before the opportunity zone was there, cannot tell you how many people looked at a deal I was presenting and said, I don't want to invest in there. I don't want to go, I'm not trying to go to Deep East Oakland. You got anything by the lake? You got, all that kind of stuff. I've seen that all the time. And that's, and some people, that's not even necessarily a racist thing. People are looking at their return on investment and saying, you know what I mean? How am I going to get my return over there? So people are scared, where I'm saying, hey, you can make income, cash flow more over here. A lot of people just have a bias, or a lot of people are just saying, hey, I'm not willing to take that risk. All right, opportunity zone fund and an opportunity zone structure will allow people, will entice capital to come into those areas because they get a huge capital gains deferral. And so if you're looking to put some capital together, look into that structure. And there's no right or wrong for any one of these structures. These are just the top ones that we can think about and put in a presentation, right? There's others as well. But these are just the most common, most popular ways that you can hold title with a group of people. right? You could also have a single purpose LLC and you own it by yourself, which is better than you owning that property in your personal name, especially if somebody slip and fall and need a bacchiotomy. You know what I mean? You need some layer of protection. So get that LLC. Very, very important. These structures are different. There's not one better than the other. This is where having a good attorney, when you put deals together, or even let's say you're going to invest in a deal, or you can have somebody review your documents, is very, very important. And a lot of times when we do other seminars and videos, we talk about investing as a plan and investing as a team. You don't want to be going out individually because you need an accountant, you need an attorney, you need an insurance person, you need a broker, all right? And you need a loan person, loan people, you need a banker. You need these people on your team to help you out, all right? Very, very important. Now, we're going to keep it pushing. Now, why would you invest in a group? Because it is a little bit more involved. There is some pros and cons. There is some risks involved. But you could be able to buy property, more property than you would be able to purchase by yourself. That's one reason. Also, you limit your liability, like we talked about before, to only the capital you invest, right? So somebody slipping for, or say, God forbid, you lose the deal, right? Do you know if you have a property and you buy it yourself and you lose it in foreclosure, you lost your money. Yeah, you did. But then you got a foreclosure in your record, right? And in a judicial state like California, if you have a big, large net worth, they could potentially come after you personally to collect on that, the money they lost, right? So if you just put up money into a deal, it's just the money that you invest. That's your only liability. Now, you can also eliminate the management hassle and responsibility by doing this, all right? You can say, hey, whoever's putting this together, y'all go deal with them tenants, toilets, and bull stuff. You know what I mean? We're just going to invest with you. Now, if you put together a group, you can, and management is not your thing, you can always hire a manager, right? And you can always do that individually as well, right? But when you invest and you're a passive investor, whoever the sponsor is responsible for that. And if you're the sponsor and you hired a manager, which is highly advised unless you got experience in that field, you as a sponsor putting it together, you have the responsibility of managing the manager and really managing the asset. You're the asset manager, all right? But if you just put up capital, you don't have that risk. Now, here's what I think is more reason why you invest in a group is you can leverage the strengths of other members of the group, right? If you get a group of people together, maybe one person has excellent credit, or one person has connections, one person is a contractor, right? One person may have property management experience. One person may have a network of wealthy friends, and if y'all got a capital call, you need some more money, they can go tap in, they can make some calls and go tap into that network, right? That is really why you would invest in a group, right? Very important. Or maybe you just get into this, you don't understand this whole thing about real estate, but you got some cash and you're trying to get into it, right? And that's another great way to do it. Or you don't have a lot of cash, but you know about the deal, you know about the business, you found a great deal. Now you can go out there and put a group together. So those are some great reasons why you would do this. And you can truly generate passive income. A lot of landlords, I talk to a lot of apartment owners all the time, especially in Oakland. They be like, I'm ready to hang it up. I'm ready to move right off into the sunset because these tenants drive me crazy, right? And you know, some landlords have a better management system than others, right? But they could sell their property and they can roll into a DST, like we talked about, or TIC, and they can be totally hands off and generate that passive income. So those are some of the reasons. Those are some of the pros of it. I told y'all I was going to keep it 100. I told y'all that there's pros and there's cons. And I think this is important as well to really, really to understand. Because whether you're going to put one together, whether you're going to invest in one, look, there's always pros and cons of anything you do, right? If you are looking at an investment or you're looking at doing something and somebody just doesn't tell you anything about the risk or, oh, there's no risk, there's no competition, there's none of that, you might want to look the other way because they haven't assessed the risk. They haven't assessed the competition. They haven't weighed out the pros and cons, right? So we talked about some of the pros, and I truly do believe the pros outweigh the cons. But here are some of them. Number one is that when you invest in a group, your investment is illiquid in nature, meaning that it's not a liquid investment. But for that matter, neither is real estate. You buy a piece of real estate in and of itself, it's illiquid, right? It ain't like you just bought some stocks and you can just call your broker, hey, you know, I need that money back, and we go ahead and sell that Tesla stock right now, and we get our money. Or we made a bunch of money, let's realize it, boom. The quickest way to get money out of your property would be like an equity line or a refinance. The second way to get money out of your property, it really is to sell it or to sell off an interest. You can sell off 10% of your property to invest in. That's hard, right? And so that's in general. When you invest in a group, you can't just say, oh, I'm having some hard times, y'all. I need to do a refi. You know, because even if you're the majority, you have the majority control. This is a group decision. Depending on the structure and how the management and operating agreement is set up, you can't just come and say, I'm having a bad day, I need to get my money out. That ain't how it goes. Now, a popular thing in the world right now is real estate tokenization. I don't know too much about that. That's essentially attaching cryptocurrency to membership interests of an LLC. That's popular. I'm learning. I'm about to go to a seminar on that. I'm gonna find me a seminar and go on that. But what they're doing with that is attempting to make real estate investments liquid, because the bottom line is they are illiquid in nature, inherently by the being property, but then also by when we put a group together. Because it ain't just about you. You know what I mean? And it's about the group. And decisions that need to be made for the group usually have to be made in the best interest of the group, right? So that's important to understand. Now, just like you may need to refinance, or you say, all right, man, let's just sell the property. We need to sell the property. No, that's a group decision. It's going to be lined out in the operating agreement or the bylaws of the corporation, however it is. But it is a group decision, right? That's why I talked about when I was the president of this, and that. What I learned how to do is how to work with a board to get things done. Work with people to massage and maneuver and finesse an agenda forward for the greater purpose of the organization. So those are some skills that you would need to have going into a group. Some real good emotional intelligence as well, because people with money get real emotional. So you have to you gotta have some cool and some smooth with you. You know what I mean, in terms of dealing with that. All right. Now, transfer your individual ownership can be difficult. So let's say we do a group, right? And what is it? 4, 10, 12 of us. Say 12 of us go into a property. We all 12 equal partners, right? We chop up the property into 12 spots. Say somebody's like, look, I am in a bad spot. Look, I know we can't refi. I know we can't sell right now, but I need my money. I'm going through something over here. You can sell your individual 12th of the LLC. You can do that. But you can't just throw that on the MLS and be like, I'm selling the 12th. And now I've seen it actually, though. You know what I mean? And Denise, I don't know if you've seen that over there in the market I have seen it on the market. I called on this one apartment building. I said, oh, I see this price. Am I reading this right? I was like, okay, no. It's $500,000 for, 0.5% of this apartment building. I was like, oh man, y'all got me. But there's not a ready and willing market out there for it like that. You would have to find another investor to essentially take your place. And they might want a discount, right? They might want a discount. They might be thinking about it. Or the sponsor or the group can then come in. Come on in, y'all, come on in. The sponsor who's putting the group together, or someone else in the group. So I might say, oh, I need to get out. I need to sell my 12th. You know what I mean? And now, we got 14. We got 14 investors in the pot. I might say, I need to get out. I don't got no money. I need to get out. And the rest of the group, somebody in the group can buy it, or the group can collectively buy it. So it can be done, but it's difficult. You understand? So that's just one thing to understand, that it could be difficult when you're selling your individual ownership interest. Yeah, go ahead.
So does the group get to approve who you sell your interest to?
Now that's a hell of a question. And that depends is the answer. Depends on how the operating agreement is written up. Mm-hmm. I would say 9 times out of 10, yes. I've seen that on a couple of times in deals I've been a part of. Is the group has to approve the members coming in. You know what I mean? Now, and the reason why that's important is because you're dealing with this person now. That's effectively your partner.
Married, huh?
You married to them in the business marriage of the deal. And life is too short to work with people, you know, that you don't like or you don't trust, or just that is annoying. You know what I mean? And we do what we got to do to make money. But yes, that's a great question, because selling that interest could be very complicated and tough. And then let's say you found somebody, and then the rest of the people is like, I don't know. You know what I mean? They can shoot you down. So when you do this, either when you're putting it together, you got to make the proper disclosures. Let everybody know this is not a flip. You're not in and you're not out. You know, we're in this together. And then if you invest in that and you participate, you need to know that, hey, this is long-term in nature, right? Those are some of the cons. Now, you also lose complete operational control, even if you're the sponsor. A lot of times, I have a client, a lot of my top clients, they don't raise money, they don't do groups. And my biggest guy is like, the only reason he don't, because he likes absolute control. He's made his millions by controlling everything. He's not about to change that right now, and he don't need to. You know what I mean? He got tens of millions in the bank, he can buy whatever he wants, right? When you buy in a group, even if you have the controlling interest, you got to get other people on board. To make, like, say, it's time to sell, we need to get together, have a conference call, whatever, let's discuss it, get a majority, now we out there, right? You can't just be like, look, y'all, we out, we selling. You know, it is a group decision. If you are investing as a passive investor, you do have rights according to your ownership interest and where you at in the deal, but you don't have control over the deal, right?
And that's where I would say where maybe a REIT would come in.
Yeah.
If you really don't want to have any control, that's where you would look at maybe. But then the downside is you won't have the potential for growth won't be the same.
Yeah.
That's where you would look at a real estate investment trust.
Yeah.
Because now you have an open market, you have a public market where you can buy and sell your shares of that. But the upside potential is not as much.
Right.
But the pros of it is if you need to sell one day because your money.
That's right. That's where, like what you're saying, when you're talking about the cons of it, that's where REITs can be. We talked about the structures of REITs, right? And that's where, like, for instance, there's one that I'm investing in, it's called Avalon Bay. They're doing really well. It's a luxury. I lived in one of the apartment buildings at Avalon Bay. That's why I invested with them. And you can stocks, so you can be in and you can be out. You know what I mean? So has more of a liquidity level than if we're out buying an apartment building by ourselves. You know what I mean? That's not publicly traded. And most of what we're talking about is not going to be publicly traded, right? So, like what Jason Matthews was saying, there's pros and cons because of that. If you really want to benefit from the upside and the intrinsic value of real estate, then you would invest into a group that is buying direct real estate, right? So I'm just busting down to y'all some of the negatives because I want you to understand what you get into. Now, I've already said decisions on buying, selling, refinance may be group decisions. Partners can be difficult. All this being said, I think, and you guys be the judge, that the pros still outweigh the cons. You know what I mean? I think the pros still outweigh the cons in terms of investing into a group, in terms of putting together a group, right? Y'all be the judge. Now, I want to break down a little bit more in detail what this whole thing of group investing is, because that's the popular buzzword of group investing is what's called syndications. That's the more technical word for when we come together and invest as a group. And I'll break it down technically. So the word group investing and syndication is often interchanged with each other. A syndicate may be defined as a group of people who form an association to undertake a business transaction. That's a syndicate. It could be, you don't have to be for real estate, it could be, and almost all businesses have some element of syndication. That's essentially what a stock market is, publicly traded companies, people putting money together to go for a business enterprise, a business transaction. Now this particular statement came from the book called It's a Whole New Business, which is a book written by Gene Trowbridge, CCIM, about syndications. And if you are wanting to get into this, or you want to understand it a little bit better, then get that book, It's a Whole New Business. You can order it online. Gene Trowbridge is an attorney. He's in Southern California. He's kind of the foremost attorney on the topic of syndications. The book is a textbook, but it is the guide to how to put these things together or how to understand them. Very, very important. But just a quick example of how this thing could all work. Say you want to buy a 20-unit apartment building. Let's say it costs $2 million. And that means it's probably not in Oakland, California, right? You know what I mean? At least not now, because I sold a 61 unit building before on a note for 400,000 in 2010. So things like we say right now, you're not gonna find no 20 unit building for $2 million. But it was plenty of properties that sold. That's 100,000 per unit. There was plenty of properties that sold before. So I don't know if we'll see that again, but hey, things run in cycles. But let's just say, for example's sake, there's a 20 unit building that costs $2 million. Say you don't got the $2 million, right? Now you can form a syndicate. And this is just an example of 10 investors who each contribute 200,000, or 20 investors who contribute 100,000, or 40 investors who contribute 50,000. Or you can have 10 investors put up 100,000 and you get a loan for $1 million. Essentially, it's breaking down investment units, breaking down the cost of a property into investment units where each investor has a percentage of the deal, right? Whether it's $2 million, $200 million, $500,000, it doesn't have to be all cash. But like I said at the beginning, a lot of people going out buying houses, right? They are competing with hedge funds. They are competing with small groups, small syndicates that are coming in paying all cash. And just out of, give me some feedback. Why would all cash structure in your group and be able to come in all cash? Why would that give you leverage in the real estate game?
No contingencies.
No contingencies, quick close. So if the seller's looking at your offer and it says all cash, no contingencies, close in 2 weeks, and they got the same offer that says 45-day close, 25-day contingency period, right? If the price is the same, who they gonna go with? You know what I mean? They might like you as a person. They might be cool. That might be your partner, your cousin. But if they're looking at that all cash, 9 times out of 10, that's what's gonna happen. So that gives you some leverage in the market, and that's what's going on today, right? You don't have to be all cash though. You can't put debt into a deal. Now, that was just like the logistics of how it can happen. And each ownership interest can be given to a person, if it's an LLC or a corporation or a DST, through a membership interest in that LLC. That interest that they have, whether that's 10% of the LLC, which is 10% of the property, 20%, 30%, is going to be based on a formula that the sponsor sets up. They're offering a certain amount of equity to buy the property, and you're going to invest in that equity. You're going to get a percentage of the deal, right? Whether that's LLC, whatever the structure is, that's how it works. Now, we're going to talk into the nitty gritty, because I know a few of you guys in here are looking to do this, right? This is all what I've been talking to you is concepts. Okay, you can put money together, you can do this. What's the pros, what's the cons, what's the benefits of it, why would you do this? In order to make it happen, you got to go out and raise the money, right? You got to go out and put the money together to make this thing happen. And the rules of raising money actually have changed as a result of the Jobs Act of 2012, which created more avenues to advertise investment opportunities for small businesses and startups to raise or mass market their advertisements, right? So you can do, if you've heard of crowdfunding, crowdfunding has been around, but crowdfunding blew up after 2012 because you get small business owner say, hey, I'm raising $100,000, put on a crowdfunding site for your business and raise it. Hey, I'm buying a 10-unit building, I'm raising $1 million, put on a crowdfunding site. There's some fees you got to pay, but now it's marketed to the world because there's rules in place that doesn't let you market or advertise investments to the public. And in those rules, and those confines still exist today. And in the past, you have to essentially network with people and make it happen. And essentially, like I say here, however, the best way to raise money is still and always will be developing relationships with people, networking, developing relationships, and offering opportunity to them. Because people do business with people they like and they trust. In general, you know what I mean? 9 times out of 10, you're gonna do business with people you like and you trust. And so it's hard. You can mass market, but the companies that are more successful with mass marketing have built up a brand that people like and they trust. You know what I mean? We can do this though as well. And it requires you maybe to develop a skill set. It requires you to develop an understanding. It requires you to develop relationship with people, a trust relationship where someone says, hey, look, I look at this person as someone as, I can invest with. I look at Deneen as a leader in the community. I can invest with her. You know what I mean? That's what that requires when you're raising money. It also requires some sales ability, some negotiation ability, some understanding of details, business skills, right? But this raising money, whether that's for your business, for your real estate, for your softball team, for your baseball team, for your nonprofit, is the key driver to making business or enterprise or any enterprise, any organization go forward, right? Nonprofits may raise money through grants or tax structures or tax credits. I coach a football team. I'm on the board for Oakland Dynamites. We're taking our kids to Colorado this year, and also we're going to take them to LA. So we was having a board meeting, and we start doing some of the mathematics and start looking at things like planes. And most of our kids is from East Oakland, so we know that if we're going to make it out there to Colorado, which would be great because I lived in Colorado a couple times. We were really looking forward to taking these kids out of Oakland and showing them something different. We're going to have to raise some money to make that happen. Go talk to some sponsors, do some car washes, and do some raffles, whatever you have to do. If you want to put a group together and go buy some real estate, you have to raise some money. You're just going to have to do it, right? If you want to start a business, you want to expand your business, 9 times out of 10, you have to raise some money. All right, you might be able to go to the bank and get some money. You might be able to get some credit card money, but you have to raise some money from somewhere. All right, and then when we're talking about for a group, you can go get a loan, but at some point you got to put that down payment down. I was talking to a client earlier today, set up a Zoom. Very interested guy, saved up some money, wants to buy a fourplex. He wants to start with one fourplex and then go buy apartment buildings. And we were talking about that. He asked me, well, I want to buy an apartment. This is my dream. How much do I need to have down? Typically 30 to 40% down. And he said, oh man, that's crazy. And I was like, but look, it don't all have to be your money. You get yourself started with your fourplex, get yourself established. Now you build off of that. And then you build some understanding. You can go find a deal. And oftentimes, the sponsor's best value that they bring to the group is that they found an amazing deal and they brought this to the table. Right? That's part of it. But you also have the understanding of the logistics of how to put it together, how to operate, and all of that. But the biggest thing that you bring to the table is finding that deal. Because as y'all know, it's hard. We talked about the multiple offers and the hedge funds and all this cash that's out here. That is the greatest value often that the sponsor can bring to the table. All right. Now, that being the case, how do you raise money? And I'm gonna break this down. There's definitely some resources online as well. How you can go. There's a brother who I follow online by the name of Peter Harris. And he's big on YouTube. And actually, I follow him, but I met him in person years ago. He was he wrote the book, Commercial Real Estate for Dummies. And he was part of Rich Dad, Robert Kiyosaki's Rich Dad Advisor series. And he's an expert. And if you follow him on YouTube, he's got a lot of great videos on how to raise capital as well. Here's some of my ideas and some things that we've done in the past and some things that I learned how you can go out there and raise capital. First of all, networking at meetings like this, right? Networking is the key, I think, to business in general. I say here, real estate seminars, trade shows, events, and mixers, right? Network is like the key to life. I'm a part of this program. It's called Goldman Sachs 10,000 Small Businesses Program. And long story short, it's a program Goldman Sachs put together, a foundation. They teaching small businesses how to build a big business, right? And they teach you all these things. And what they say, the biggest benefit of going through the program is that now you're going to be a part of their network, their alum network. And when you go to New York, they fly us to New York. We do all this stuff at Goldman Sachs. Is they open up, they have I think 3 or 4 different networking events that we're gonna all be out there networking. Every class we had, they mentioned networking, right? Because that is the key to business. I talked to you guys about the different networks that I have the opportunity and the honor to be president of, right? Those are networks. I've closed deals out of all of those organizations and groups that I've gone to. I've been going to business mixers since I got into business. I mean, when I was in San Jose State with holes in my socks, and you know what I mean, and didn't know how to tie a tie, but I was at the networking mixers trying to make it happen. You know what I mean? And that was where I learned how to really to do business. I don't care what business you're in, but particularly raising capital, because a lot of the ways you're even if you're mass marketing, it's just hard to build trust in mass marketing, right? Like we're having a seminar here. We've been doing webinars for the last 2 years, and praise the Lord for Zoom, right? Thank you, Zoom, and the other platforms. But it ain't nothing like sitting here and looking at your eyeballs and being able to shake your hand, being able to have some wine, some hors d'oeuvres and stuff. There's nothing that beats that, right? And so that's why networking, whether it's raising capital, starting your business, expanding your business, selling real estate, selling whatever you're selling, you know what I mean? I mean, even I grew up in East Oakland, even in the streets, people that's the street hustlers, they network. You know what I mean? People that are in the sports world, right? Scouts and coaches, they network. That's a universal thing. It's the number one way to build your business. And it's the number one way to raise money. Now, you also can approach pre-existing business acquaintances. That is, if you are in business, and that is if you've got a good reputation. I think I said reputation 4 or 5 times in this presentation. Very important, right? So when we're doing things, it doesn't matter what your job is. Like I was telling you, many investors have full-time jobs somewhere else, right? But it's about what do you do, how do you do, the integrity in which you do it, and how you carry yourself that is going to attract people to say, hey, that person is somebody I feel comfortable investing in, right? Very, very important. So if you're in business, though, and you've done good by some people, and it opens up the door to say, hey, I got this project over here, it's undervalued, great return. Would you consider investing if the terms are right? Something to that effect. Now, current and past clients, which is kind of the same thing, but maybe different. Depends on your business, and you got to be careful with this because you don't want to, some businesses you don't have conflict of interest. I know in the banking world, securities world, that's a big thing. Like in securities, I think they call it like selling away. So, you have to be careful with this. In real estate, though, if you have clients, you've done well by them. I've done a few group deals with people who I just started off brokering deals for. We developed a great relationship, and we did some business, right? It's a great way to do it. Now, referrals, though. Referrals. Again, whether you are raising money or whether you are out, selling biscuits. You got the brand new biscuit formula. You got some gluten-free honey biscuits that you're about to sell and put on the market, right? A great way to do it is to get referrals. Well, who can I sell these biscuits to? What bakery or coffee shop or whatever is looking for some new product? Ask for referral. That's the thing I think. And I talk to my agents, and I don't talk to my agents enough about this. What we bring it up is asking for referrals, right? My mom used to say, what is it? Closed mouth don't get fed. Now, I ain't have a closed mouth when it comes to eat plates. You know what I'm saying? I used to be a shy person, but that concept, like, cause I like food, I love food. That kind of learned that at an early age. If I want to get a second plate, I used to always like to come like when I like some food, I like to get a second. And you gotta ask for it. You know what I mean? You gotta go in there. Like my big mama house, when you go in there, I'm always trying to get 2 or 3 plates. And my auntie would be, she's like the guardian of the plates. You know what I mean? And so you got to come in there with some smoothness and, TT, I was just wondering if I could get another plate in there. You know what I mean? Because the closed mouth don't get fed. So you have to ask for it. Now, so you got to be smooth. You can't just, you got to have some swag and some smoothness when you're asking for referrals. But it is an art form, and it's something that you got to ask for. So like in real estate and sales, I always talk to people and say, well, who do you know who might be doing in a 1031 exchange right now? Or who do you know that might be thinking of selling their property? Because I have someone who's in a 1031 exchange right now. Or who do you know who might consider investing in apartment buildings? Develop some questions that you can ask people that would engender them giving you referrals. Don't just wait on referrals. Most of our business, by the way, is done via referral and brokerage and everything else. Now, we do YouTube ads, we do Google ads, we do emails, we do social media, we cold call like dogs, right? We follow up call. Referrals, though, are still the most consistent source of business. Because we've been around for a while and people know us and understand us. If you're just starting, right, it's going to be hard for you to start up and get a bunch of gang of referrals. but you can always ask for them though. And that's what a lot of people don't understand. You don't have to have no experience to ask for a referral. It's just a matter of having the confidence and having the right approach to go ahead and ask for it. Right? Now, here's another thing that's worked well for me. Approaching wealth managers and financial planners. Financial planners like my guy Jay Matthews right there. Wealth managers, people who handle money, CPAs, attorneys, because these are the handlers, the people who are handling specific things for wealthy people. And those are great inroads to talking to their client or meeting their clients and presenting them a deal. Now here's another thing. Those folk, their reputation is their business. So they're not going to refer you if they don't know you and they don't trust you. So what you start doing is developing relationships with these folks before you need them, right? That's why you got to be networking. There was this group called NABA. I think NABA's still around, National Association of Black Accountants, right? And I started going there and networking there. And I was working with a gentleman who was one of the board members of NABA, and he said he was buying apartment buildings, and I was helping raise money. He said, look, you want to come to this, you want to be around this. Most of the accountants, they're not going to invest, but you know what they're going to do? They have a bunch of clients who got tax needs, and their clients invest, right? So you develop relationships with these people. Same thing for wealth managers, financial planners, stock. For everybody who buys stocks, not everybody, but 9 times out of 10, at some point they're going to buy some kind of real estate. And if not just for tax purposes, right? And people who buy businesses, the same thing. So you want to get in that sphere, you want to get in that circle, and there's all kind of networking opportunities out there. It's starting to open back up to like this. Like I told y'all, this is the first time that we got back and we're back in action in person in 2.5 years. And I'm blessed. I'm glad you guys came out. This is amazing, right? So everybody else is starting to open up too in here. I know in Texas they never closed down. You know what I mean? In the first point, you know what I mean? If y'all in Texas, I know y'all never closed down. But out in the Bay, we was on lockdown, for a while. So now this stuff is opening back up. And ARPB has a mixer next Friday. I don't know that Mike's not here, but ARPB is having a mixer on Friday. There's a whole CCIM is having a mixer in a couple of weeks. Everybody's coming back. So make sure that you're out there. Make sure you're talking to people. Make sure you're getting known. Right now, another thing is property owners, current property owners. A lot of times these folk want to own their own property, but what if you found that person who was ready to ride off into the sunset? They got a 20-unit building or a fourplex or a house, and that they're like, man, I'm done with these tenants, but I'm not trying to pay all these taxes. So I'm gonna sell this property, and I'm looking for a DST or somebody to partner with or something. You could offer them a very great solution to their challenge of not wanting to manage property. If you find a deal, you can roll them over into that deal. So that's another great avenue of being able to raise money. Now, I put crowdfunding site last. You can engage a crowdfunding site. You can do that. But I put that last because it's possible, it's doable, but you really gotta have some experience. It's almost like I think the people who have had success raising money on crowdfunding have had success in the past. And so when people are researching them, they're like, okay, they've done all this stuff, so I feel comfortable. Because again, people want to do business with people they like and they trust. It's hard to build that trust online if you just coming at them for the first time. You know what I mean? If you have some sort of reputation, though, if you have some sort of following, now, if you have a social media following, now this is a new word, because a lot of people may have big social media followings, but maybe don't know nothing about real estate. This is a great way, crowdfunding, for you to leverage your social media following and leverage your online presence, leverage your online savvy to raise capital. All right, a lot of people have these networks and just aren't quite sure what to do with them. A network is valuable, period. And a great way to leverage that, if you do have that, is to then be able to engage a crowdfunding site and go ahead and go out there to the marketplace. Now, I'm gonna get a little bit more in detail. I talked about some of the methods of how you can raise capital. Now I'm gonna talk about some of the prospects, right? The people. And this is very, very important. And there's no particular order here. I just wanted to kind of show a different way of looking at this. Who are some of the people who would benefit from investing with you in a group? Or if you might be one of these persons and this might be a benefit to you to invest in a group. First of all, individuals who have self-directed IRAs, self-directed IRAs, because self-directed IRAs and a self-directed IRA simply now, people doing 1031 exchanges. We talked about this before. People who are selling properties, looking to defer the capital gains and reinvest it. Many of those people also are not willing to deal with the management hassles of real estate. They want to invest in a DST or a TIC or a group investment structure, right? So you've got to work on developing relationships where people are going to be exchanging. That's where having great brokerage relationships, very important. Also, busy professionals who got money and capital, but they don't necessarily got time or expertise to go out into the marketplace and do business deals. If somebody's a tech person at Google, they probably working 80 hours a week. They in the tech world, but they working them. You know what I mean? If you know anybody in tech, they work hours. You know what I mean? And that's why they have all that stuff at the campus. But they don't want them leaving. They're gonna start doing campus housing at the office pretty soon. But they got gyms there. They got cafeterias. They got
Laundry,
haircut,
barbershop.
Because they want you there because they go out to get they're out to squeeze every bit of production they can out of you. So if that's you, it can be very difficult for you to go out and invest in your own. Now, not impossible, like I was saying, a buddy of mine, one of our agents here, he works for Apple. Apple is a tough company to work for, great company to work for, but he also invests on his own. He also sells real estate, right? So it can be done. But a lot of those folks, they try to make it to the mountaintop in their field, right? And they try to say, hey, I need to put all of my efforts into being a tech master. You know what I mean? So they're not going to have time to go out and find investment properties. Or they maybe don't even want to, but they know that it's a great investment. So that is a good person, a great target of someone who might consider investing with you into a deal, right? Now, ambitious investors seeking to invest in projects that are larger than their own, than what they can do on their own, right? So a lot of time investors, real estate investors, they want to control it, they want to have the control. But some folk are ambitious to the point where, look, they try to do something bigger than them. And so they're looking for people to partner with, right? And that person may not be a passive investor, but they might be a great partner. They might be a great person to have. I say might, we got all things considered. But those can be some great partners because they're ambitious. They're looking to do things. They might be willing to take on the debt risk if you ain't trying to do that. But you're trying to buy something that's bigger than you, and you hook up with them. Now y'all can do it together, right? Now, also people who have realized the capital gain. I talked about 1031s, but to my knowledge, I'm not an expert. If somebody sells stock, I don't think there's a way to 1031 exchange stock. And maybe I know there's not a way to 1031 exchange. Maybe there's some other avenue of what they could do. But I know most people when they cash out their stocks, they're going to pay capital gains. When they cash out their company, they're going to pay capital gains. When they cash out their art or their precious metals and all these other things, there's capital gains. And I know some of that stuff you can exchange. But for the most part, a lot of times you cannot do an exchange, or if you're trying to do an exchange, it's very difficult, right? So they may have realized the game and want to invest with you. Say you set up an opportunity zone fund, now you've created an avenue in which somebody can invest. And now these are the ideal prospect for someone who wants to invest into a group. And if you are looking to put together the group, we've gone through the pros and the cons. We talked about what it is. We talked about the significance of it, right? We talked about, okay, how do you then go out and raise capital? What are some of the methods? We talked about who, right? And so this is a baseline for you to be able to go out there and make it happen. It doesn't mean that, you're going to do it or it's right for you, but this is what's possible. And at the very least, knowing what's possible, you can apply this if you're trying to buy a single-family home. You can apply this if you're trying to buy a fourplex. You can apply this to buy a hotel, right? You can apply this to do some good in your community. You can apply this to, a lot of people do this too. Put 2 or 3 people together and they go on a home loan and now they living as a team. In fact, a lot of families do that, right? This is ways how you can compete in today's marketplace. And in fact, in a rising interest rate environment, in a changing business environment where there's uncertainty and volatility out there, there typically is going to be some opportunities that follow. Most people are going to be scared at that time. They're not going to want nothing to do with it. That might be your golden opportunity to go out there and do so, right? And also to team up with the right people to make a positive impact and generate a yield in return for you in order to build generational wealth for you and your family. Very, very important. And just to give you an idea, I can't go into the details, but what we're doing is we're developing an Opportunity Zone fund, OZ fund. Paul Chambers, who owns this property is called the Chambers Complex. And it's black-owned property, Paul Chambers, Chambers family, third generation in the construction business, and him and his family are savvy real estate investors. So we've got 2 sites on 73rd now, the old Soul Beat property and another property, that those sites are going to be developed. They're going to be developed into what we're calling the Palms development. It's going to be 8 ghost kitchens over there, a multimedia center, outdoor event center. There's going to be a restaurant and a beer or wine garden that we're going to put in there. Those plans, those are properties that are owned. Those plans are in motion right now. And that what we're going to do to build that, the sites are already owned. What we're going to do to build that is raise capital through the Opportunity Zone. And next month, we're going to be talking about what an Opportunity Zone is, an Opportunity Zone fund. And I have my boy Jason Matthews right here. He's going to come in and talk about, kind of give an update on what's going on in the economy as it relates to interest rates, right? But that's one thing that we are doing. Another thing that we're doing, we're in contract right now on a big property in Stockton that is also in the Opportunity Zone, right? And that property is a 30,000 square foot, hotel with 7,500 square foot of retail space on the ground level. It's appraised for $1 million. We're buying it for $595,000. While everybody else out here wrangling and wrestling and multiple offers, we found us a deal, right? And what we're going to do is we're going to develop that and put veterans housing into the 40 units upstairs, and some services for the veterans downstairs, and we'll have commercial space at least that was right across the street from Stockton's City Hall, which I said is also an Opportunity Zone fund. So these are just an example of what you can do. This is what we are doing. That's something that is interesting for you to either participate or do yourself. Make sure you schedule some time. We sit down and we talk about it. But I wanted to just not talk concept with y'all. I wanted to tell you, if you drive by 73rd right now, right across from East Mount Mall, you're gonna see a big red and black fence and with some plywood over there because we secured the site, had to take one of the fences down because it was about to fall over. It was a code violation, had to take it down, put up a temporary fence. Now we're waiting for the good old city of Oakland to approve these plans. But this is in motion. This is a black-owned development that's gonna be happening in your city right down the street. And we're also gonna be taking this to Stockton, right, which I believe wholeheartedly is Stockton as a city that is experiencing a lot of growth and that has all the infrastructure to receive all this spillover growth from the Bay Area. As things are so expensive in the Bay, people are continually moving to the Central Valley. We're seeing companies now move to the Central Valley. Amazon set up a distribution center out there, and I believe they have employed over 3,000 people out there. And when Amazon set up shop, other people follow. So what I'm just talking to you guys about is something that is happening right now, and it's something, things that you guys can also be a part of or take advantage or structure yourselves while the rest of the world might be going crazy. While the rest of the world is now realizing that all these houses went up in the stock market, all went up because the money was cheap, right? I'd be like, how did the stock of homes go up 30, 40% in the middle of a pandemic? You know, how is that even possible? But when money's 2% and you can't go nowhere but in your house, there you go. When the money's 5%, all right, it might be a little different. And so when that happens, there's uncertainty in the marketplace. And so uncertainty creates stagnation. People just say, oh, I'm uncertain, I want to fall back. But what I'm telling y'all is, have a diligent mind and be aware of what you're doing, but that can be your opportunity to build wealth for your family. Now, this is my call to action for y'all. We're gonna wrap it up. And if you have any questions online, if you have any questions, now will be the time. But this is some action steps for y'all. Decide if group investing is something that you would like to participate in or something that you would like to arrange, right? You might sit here and say, nah, you know what, it's too complicated. I don't want to arrange it. I don't want to participate in it. But you now know the basic fundamentals of it, right? So make a decision of that. Now, if it is something that you want to do, link up with people you like and trust. We talked about that before, the like and the trust piece, right? That's important. You don't have to link up with corporate America, man. You might not trust them anyway, you know? But link up with people you like and you trust. Decide what type of properties that you want to go after, and put in place your investment criteria. I have a few videos on the YouTube, and if you're not subscribed to the YouTube, subscribe to the channel, because we put all our content on there on a consistent basis. And you need to develop a very, very clear investment criteria. I had a guy reach out to me, very, very astute investor. He works for a company, and their big company in LA reached out to me. They sold a couple of properties there in exchange. He said 3 to 15 million, what I'm looking for. He gave me his criteria. I pitched up 3 deals. He told me no, but he told me no in a way that motivated me, because he could tell me no immediately, but I don't like these properties because of boom, boom, boom. That tells me as a broker, oh, he's serious. He knows what he's talking about. He knows what his criteria is. He can say no quick. And he didn't say no, oh, don't send me no deal before. He said, no, Steve, thank you for sending me this. I really appreciate this. This does not work for our model because of boom, boom, boom. And so every property I send to him, and he tells me no, gets me closer to me sending him the property that he's going to like. Because he's very clear about his criteria. Because real estate will pull you this way and that way and all those over. And you be condos, single family, shopping centers, hotels. You figure out what type of property that you like the most, you get an expertise in that. After you've done that and you want to go buy a movie center, God bless you. But get your expertise down first, and then put a strict criteria about how you want to do that. If you're wondering how to do that, go to our YouTube station where we have put your investment plan together, that video, and investment criteria video. Check that out. Consider working with the group or starting your own, right? You guys all came here for a reason, so consider it, seriously. Or if you're gonna start one on or participate one, but this is how we start making an impact in our marketplace. This is how small businesses, small investors can make it. In Oakland, they're making it very difficult, San Francisco too, for the small investor to win with all the rules and regulations they're putting in place, which many are well-intended, because they're saying, hey, this is so expensive for people to be able, we gotta make something for the people. But a lot of these rules and regulations are actually squeezing out the very people it is intended to protect. And so the small and mid-sized investors are having a hard time, wherein the big corporate investors can go come in and swoop, like they've been doing, like they're gonna continue to do, because they can come in and buy a property with very cheap rents and offer the tenants what's called a golden ticket. Here goes 100 G's, and you give me those keys. Here goes 70 G's and give me those keys. And they do it. And somebody who maybe never saw that kind of money in their life will say, all right, I don't like this neighborhood, no way. Give me 100,000, I'm out. And then what happens? And then the neighborhood gentrified, people get displaced. And meanwhile, the small and mid-sized investors, they can't do that. So they struggling, right? But it don't have to be that way. We can come together, rub some nickels together, put some resources together to go out and make some things happen. Just don't do nothing, right? Take action. Even if you say, I ain't doing this whole group investing thing, I'm going to do my own properties. If that's what you got out of this, great. Because now, maybe that's the action step, the catalyst for you to take an action step to go ahead and make that happen. My thing is just like, don't soak up all this game here on the internet, at other places where you go and learn, and not do nothing with it. So many people in the real estate game, will go to 1 million seminars, read 1 million books, but then don't do nothing with it. You can read one seminar, or go to one seminar and read one book, and if you just took the action steps on that thing, you would be more successful than 90% of people that went to a seminar every month or read a book every month, because it's all about the action. It's about that action. Take it, right? For yourself, for your community, for your family. And if you need some assistance, whether it's putting a group together, whether it's learning about real estate, whether it's investing in real estate directly, work with us at Infinity Investments. I'm going to say it again. I mentioned the YouTube station a couple times. A couple of y'all on YouTube, thank you guys for supporting. Share it, like it, put it out there. You have a question?
Yeah.
Yeah.
For the one where it says, link up with people you like and trust.
Yeah.
What if those people aren't? What if those aren't the best people?
Well, that's a good question. That's a great question. Because when you said, hey, I said link up with people you like and you trust. What if the people you like and you trust aren't the best people, right? It's a valid question, right? Because there's a very valid question because y'all know, y'all networks, right? We all know our networks. We got some people we like and we might trust them. And they might not be the ones. You know what I mean? They might not be the ones. So the answer is that you gotta find some other ones. You gotta find some more people, right? Like you're a baseball star, right? You're a baseball star and you coming up, right? You probably gotta work around some other baseball. If you're a baseball guy, baseball star, and you only hang out with, let's say, football people, that might be great, but that might not help you. You know what I'm saying? Whereas if you're a baseball guy coming up like you are, right? And you coming up your 8th grade now, you might want to, and then you might have some baseball buddies. They cool, but they might be on a certain level. You might need to go hang out with the high school guys and just, maybe hang out with them, but at the gym, watch what they're doing. Ask them what kind of workouts they're doing. Okay, well, where are you guys? Where do you go? What do you eat? You know what I mean? Do you have a trainer? Just the same concept to that. When we're talking about business would apply to sports, would apply to anything. Because you have to have a network that's going to support what you're doing. And if what you're saying is the case, if many of us, what you just said, that's a young man. Everybody give a round of applause for this young man asking a great $1 million question. Sometimes you got to go out and seek that network of people because it may not be in your household. It may not be in your neighborhood. It may not be in your school. It may not be in your company. It may not be in your area, right? Doesn't mean you don't love those people. Doesn't mean that you abandon them, but you might just got to step outside of yourself in order to associate with some folks that's going in the same direction that you're going. You know what I mean? A lot of people from my neighborhood I love, or people I went to school with, I love them. I see them. We can kick it for a second, but I can't necessarily chop it up with them 24/7 because we go in different routes. You know what I mean? And we got different things that we're doing. You know what I mean? I can see him at a barbecue, at a family thing, or whatever. But what I'm saying, I might not, if I'm only chopping it up and kicking with him, that would be cool. But I'm not gonna be able to get where I'm trying to go in that way, right? And that's now in this day, you can tap into people. I got so many people I follow, man, on YouTube. And YouTube is great because it's a lot of instructional. Instagram and TikTok and everything else, and LinkedIn is out there too. But people are putting content on YouTube daily. So when I wake up in the morning, I'm just a variety of people I'm associating with online, right? If I'm working out, I'm on the way to the gym, I'm listening to E.T. the hip hop preacher. Get me juiced up. I can, I will, I must. You know what I mean? E.T. the hip hop preacher. You know what I'm saying? Beast mode, 1, 2, 3. Beast mode, 1, 2, 3, right? That's my gym hype, right? Then I start my day, I'm getting home, I'm making my breakfast or something. I listen a lot to Valuetainment. This guy, Patrick Bet-David. He's a big entrepreneur. He does a lot of content. Got a lot of content out there. You know what I mean? On Thursdays, especially in the sports, there's Ray Lewis. He does this thing called Championship Thursdays. Championship Mindset. It's every Thursday at 9 o'clock. So every Thursday at 9 o'clock, I'm tapped into Championship Mindset. So you can associate with these folks online, in person, whatever, but you just got to make sure you're doing that. You know what I mean? And when you actually do some business, and you found those right people, you got to like them and you got to trust them. You know what I mean? And you never know. Life is, somebody and like they might burn you too. I mean, that's a part of life experience. You know what I mean? But you got to go through it, and you got to be diligent about it. And make sure y'all tap in with us, book an appointment with us. You're looking to buy, sell, invest, real estate. We need some guidance on something. You know what I mean? Make sure you tap in with us. You see the stuff we doing. You know what I mean? So just be a part of it. Do something. Before we wrap it up, is there any other questions here or online? Yes, ma'am.
Like you say, you have 10, partners together. How do they do the taxes and write-off? Who handles that part?
That's an excellent question. So now the LLC, let's just say LLC. Make it simple. All right. The sponsor is responsible. The person or the group that's putting it together, and even that can be more than one person. Right. The sponsor is responsible for all the accounting and bookkeeping and reporting of the LLC. Now, so they have to have, and they should have a CPA, Certified Public Accountant, that they work with to get this stuff handled. Now, LLCs in most entities for group investing are what's called flow-through entities. So let's say you own 10% of the LLC. The sponsor's gonna do the tax returns for the LLC, and they're gonna issue something called a K-1. A K-1 is almost like a 1099, if you will. K-1 says, you investor, you own 10%, the property generated $100,000 of profit, so 10% of that is $10,000. You have $10,000 of profit from this. You have $4,000 of depreciation, whatever that is, you will get what's called a K-1 individually. So the sponsor does that for the group and then gives everyone their individual K-1. And that's on the LLC, there's different structures. But the sponsor is responsible for it. If you are doing that, you are responsible for that. But you need to get a CPA, not H&R Block, not Quick Tax, nothing against them. Nothing against them, but you need a CPA because it's a little bit more complex, a little bit more involved to when you're doing that. And then that way you get your K-1. And that's why a lot of people love LLCs because they're flow-through entities. Whatever your percentage of ownership is, you get that cash flow, you get that tax depreciation, you get everything that flows through with the property.
One more.
Yeah.
Now, you said the LLC, right? How do I put my fourplex in one? I gotta get a lawyer to do that, right?
Not necessarily. Yes, it's advised to get a lawyer, but you don't necessarily have to get one. You have to form an LLC. You can go on LegalZoom and form an LLC. The reason I say it's advised to get a lawyer because you need somebody that actually is doing that in conjunction with maybe your estate plan, your overall plan. But you could go on LegalZoom, form an LLC, and then go to a title company and deed your property from you personally to your LLC. It's a transfer.
Okay.
So you can do that. You can do that. I think it is wise to get an attorney involved. Attorney can do that for a couple of $1,000s.
You know the saying, don't be a dollar short. Don't be penny
wise,
saved,
yeah.
a penny wise and a dollar
Dollar
short. You know what I mean? Oftentimes we're talking about here in the Bay Area, everybody has an asset that's worth $500,000.
Right.
Why are you trying to just be so cheap on it? It's a $500,000 asset.
Right.
Protect it the right way, right? It's $600,000. I think oftentimes I see, especially in our community, where we try to be so frugal without doing the right thing. So
Yeah, and I mean that's right. And so that's why it's advised to do that.
Right, that's what I said.
Yeah.
I'm not trying to be cheap.
Yep.
I understand.
Get information.
But now listen. Now here's something. Here's a little bit of game on that, okay? Because you can go to LegalZoom and form your LLC. Boom, form your LLC. Then have an attorney draft or review the LLC and then do the transfer for you. That would save you probably $1,000. You know what I mean? So that's something you could do. Now, you know what I mean? Or like for instance, we do a business document. We can create a document and then send it to an attorney for their review. Versus if you have them to create the document, let's just say, it may be, maybe that might be $3,000 versus review may be $500 to $1,000. When they review it, they see something they don't like, you can tweak it, right? And that's just one thing as a business person. When you're running a business and you got a lot of expenses, you may have to be frugal to an extent. But like what Jason is saying, we don't want to save a couple pennies and lose dollars, right? You know what I mean? Now, on that note, a lot of people own properties in their personal name. It makes sense to have an LLC. It makes sense to have a trust. If you know what I mean, a lot of like your personal residence should have a trust. And that's another. Now that we back on these seminars, you know what I mean. We're gonna have somebody come down and do some estate planning because that's a next piece because it definitely should be a planned out. And for instance, when you're putting that property in LLC, it should be part of your plan, not just hey, I'm putting this. In.
That's right.
You know what I mean? So therefore, it should be somebody putting that whole plan together.
There you go.
Make sense?
Yeah.
Yes.
Yes, so, thank you for all this great information. And I was curious to know, what is the expected timeframe, for a return on a syndicated investment? Like, is it monthly cash flow? Is it more long-term, like 5-10 years?
Yeah, that's a great question, right? And it depends on what the deal is, right? If the syndication is, let's say, purchasing Class A apartment building, or are you guys gonna purchase it and it's already cash flowing and you know what I mean? The returns can begin immediately. Although typically, even on a fully performing asset, before the syndication begins to pay out, it needs to get its arms around the property. So they'll typically say, the first quarter or two, we're not gonna pay out because we just got this property. We need to build up a reserve, we need to understand the property, and then start paying out. I did a fourplex deal with a couple of partners, and we didn't pay out owner draws for like the first year or two. However, we were stacking that money, you know what I mean? And when it was time, we was able to start drawing it out. But what we did collectively is that before we start taking money, we need to have 10,000 in the bank. Because real estate, you know, one month you may have to fix a hot water heater or whatever. So it depends on the type of the deal. Now, let's say it's a development deal. That could take, there's gonna be no cash flow on that for a period of time. If it's ground up, from the ground, that could be 2 to 3 years, a year, 2 years. If it's a renovation, that could be 6 months to a year, you know what I mean? Depends on what that is, right? If it's triple net retail, triple net means the tenant pays for taxes, insurance, and common area maintenance. They could technically start paying immediately. You know what I mean? So it does depend on the deal. Most syndications, though, are going to allow, the reason most people invest is for monthly cash flow and quarterly. Most people pay it out quarterly. Because the way real estate works is things balance out better in quarters or years than they do monthly. Because you may have 1 month where you don't make nothing, and then you may have 1 month where you make $6,000 positive cash flow. Because 1 month somebody might have moved out, and you got to come in there and turn the unit, right? So it does depend. It typically is going to be, even for a cash flowing building, it's going to be at least 1 or 2 quarters before they start paying you out. But like what we did, we had a fourplex, we stacked up 10,000. I think that took like a year and a half. That 10,000 is money in the bank. So while it wasn't paid out, that reserve, that amount, each partner in there had their right or their claim to that percentage of the cash. So it was cash to their account, to their benefit, but they didn't get it yet. Because our agreement was, hey, we're gonna stack up 10 G's before we start distributing. So it depends on the deal, and that any deal where you invest in like that, those terms are gonna be broken out into either the operating agreement or the bylaws of that, right? So that's a great question, and that is typically gonna be, so usually 6 months to a year is when you start getting paid.
And plus, also remember during like COVID, when you saw syndication and REITs when COVID first happened, there were just a lot of people just stopping it, boom, because we weren't sure what was going to happen because of the rents and everything when COVID first happened. So even if it's in the bylaws and everything, you in this crazy world we live in, you simply never know.
One of the 4 people want to move into the unit. Is that like a conflict? Have you ever had that scenario?
Well, no, I mean, that's now. I mean, okay.